I'm ready. Hi, I'm Shawn Cumberland of EnCap, EnCap Investments. I'm a managing partner of the energy transition group within EnCap. EnCap is a private equity fund manager that's been around for about 30 plus years, and it provides growth capital for companies and management teams that are in the power and oil and gas and midstream sectors. To date, it's backed over 240 management teams and companies. Our topic today is near and dear to my heart. It's the finance of emerging startups in energy. And what we've done is we've assembled a panel that includes folks that have been investing in startup companies, provided growth capital, venture capital, but also we've asked one of the leading investment banks in the sustainable and renewables to talk as well. So I'm sorry, did I just start? Anyway, I'd like to introduce our panel. Paul Hobby is a co-founder of Genesis Park. He's been a CEO of a number of companies, so he's seen companies from the inside. He's been a longtime investor and sponsor and backer. Paul was the former chairman of the Greater Houston Partnership, as well as the chairman of the Houston branch of the Dallas Fed. I know that the backing of entrepreneurs and companies is near and dear to his heart. He's got a passion for Texas and Houston in particular. He's seen, media companies, tech companies, infrastructure companies of all type, but also energy companies. And so, Paul, on this panel, I'm going to start with you just because I've known you the longest, I think about 36 years. We can count the time we first met. But could you speak a little bit about, why you set up Genesis Park a couple of decades ago and what you guys do?
Well, there's an irony here, of course. When we set up Genesis Park, we were the non-energy guys in the energy town. And so when you'd go to New York to raise money, they'd ask you about the price of oil, and you didn't know whether to talk about the price of oil or not. But fortunately, energy is no longer a code word for hydrocarbon, and witness the pivot that EnCap has done with Shawn and his team as verification of the transition phenomenon that we see all around us. Specifically, Genesis Park, we've done a lot of tech, a lot of telecom, a lot of one-off sort of industrial deals that usually embrace technology somewhere in the equation, or they wouldn't otherwise meet our criteria. I have messed around with the solar business for 10 years on an individual basis, and so have messed with that with my money, and then we've started to put fund money in it a couple of years ago, and we're starting a solar finance business beside the largest EPC in the state where we have a significant position, Freedom Solar. But I've also had this perspective at the macro level. I've been a board member of NRG for 12 or 13 years, something like that. We went early to car charging. We went early to all the renewable stuff. And when you're investing, being early is almost worse than being too late. So we had the vision for the tipping point that's now occurring, but we deployed capital too soon and had to divest through some of that. And now we've sort of found our place where we're playing up and down the merit order without any particular bias, whatever customers want. So I've seen large scale deployment too early, and I've seen small deployments on a personal level and on my fund level, I hope at just the right time.
Yeah, every experience is a valuable experience is what I've taken away. So using that, how is it that you source your opportunities and then screen and then determine, which groups of opportunities? Because I'm sure there's a multiple of opportunities that come to you. How do you pick which ones you're going to go after, Paul?
Well, we try and drive in our lane. We know our limitations. If there's something around batteries, I call my friend Shawn Cumberland, or I call a couple of other people who know more about batteries than I do, and I beg for counsel and advice, and I generally give it. I generally get it because I do the same thing in return. If it's something that we think we know something about, obviously we'll do the same character test anybody else will. And you hate to say it's cliche, but you cannot do a good deal with a bad guy. So if there's somebody who this is their 14th startup and they've got angry investors and they've had 4 or 5 wives, then that's the end of the conversation. But if they have had persistence and they've had success, not to say everything had to succeed, then just move on down the list. Are they qualified? Is there alignment? Do they have skin in the game? Do they have proper incentive? Have they screwed up their cap structure? Avoiding debt and exotic securities on the front end, to me, is a litmus test about whether you understand how this all works. And then the other litmus test, and maybe this isn't fair, but when people come in with the Chinese army argument, and that is, gosh, energy is a $14 trillion business, and all we need to do is get 1% of that, and we're going to IPO next year, by the way, that's our exit. That just tells you that they're not grown up. They don't understand that this is a niche business, and you can't just do macro math and pretend that feels like success. And then finally, I'll say, have they achieved commercial proof of concept? And if not, they ought to build a company to do a trial. And because, any big company, anybody, anywhere, ERCOT, they're going to want to make sure that you can serve load when they call your generation. So, build a commercial trial of technology that already works at scale. So I've probably said enough, but that's our list.
Yeah, and where do you fall in the spectrum of like the life cycle of investing? If you've got angel on one end of the spectrum and then, a very, very mature company, where are you in that continuum, Paul, or do you have a wide range that you invest into?
Well, we've been doing controlled private equity for a long time, and we obviously want things that if there's a problem, we know how to fix it. So pretty far along. We're not technologists, and we're not looking to capture eyeballs or market share. We want real businesses with real cash flow. Right now, we're investing out of an SBIC fund, which pushes you even further up the balance sheet. So right now, if you've got something that works and you need to swap out shareholders or finance growth against a contract with the DoD, we're a good audience for you. If you've got something that you think it might work, then you should go see Shawn for sure.
Thanks. And send them my way. So let me introduce Mike Freeman. Mike, I had the pleasure to get to know by serving on a board and being co-investors in a company that EnCap was one of the early investors into. And Mike has been both in government roles and in investing roles, at least the last decade of EnCap, which, as Paul is to Texas, EnCap appears to be to the mountain region in Colorado in terms of wanting to promote local startups and the emerging capital markets for that. So, Mike, why don't you say a few words about what end of the spectrum you play in and what EnCap does?
Yeah, thanks, Shawn. Appreciate the invite to be here today. And Paul, we're definitely way before you all. So
yeah, I'm sorry.
How's that now, Shawn?
I'm sorry. It could be my internet. We just moved into a new building. I may have to dial in another way. Can anyone hear me? No.
I can hear you.
I can hear you.
Mike was just
Okay.
a little scratchy, I think.
I'm sorry. Yeah. Mike, can you talk about EnCap and what you guys do over there?
Yeah, sure. Hopefully this is a little bit better. Does that sound more better quality?
No, it's a little bit rough. I don't know if you need to reboot. Maybe I'll switch to
tinny,
Ari while you reboot. So while we work out our technical difficulties, let me shift over to Ari Prabhati, who, when I think of the investment banks that sort of lead in the sustainability and renewables space, I mean, Marathon Capital is on a very short list for me. And Ari, you've been on the investment banking side for, I think, about 25 years, but before that, you had an engineering and technology background. So a lot of times I see you on these big sales transactions, but what's interesting to me is when I get decks from you to back teams or technologies or startups, and it seems you're playing on both the large end and the backing of the small ends. But I hear you light up sometimes when you're talking about the new thing. Why don't you talk about what do you do when a management team comes to Marathon and says, "I've got this great idea, this project, this technology. How can you help?"
Yeah, no, good question, and thanks for the plug on my firm and me, Shawn. So we typically look into key themes around where the startup is operating. Are they in sustainable fuels, for example, or are they in renewable electricity? Are they in e-mobility? Are they working on emission? And we tend to focus on those four key segments for startup investment when we consider client. And we also look into, is it something that's completely going to turn things around from a technology point of view, or is it something that's providing optimization adjacent to existing mainstream technologies? We like the latter part because technology risk, I think, is we have so much more technology convergence when it comes to startups in energy sector. We're not looking into the concentrated thermal solar anymore. We're looking at PV. We're looking at certain type of wind or certain type of renewable fuels technologies. And what we're looking really and focusing on are companies that enable lower cost of energy, lower cost of emission, lower cost of carbon capture, and also in the exciting field of e-mobility, where we have a lot of clients and help a lot of startups to get to the next level in their capital raise and commercialization plan.
Ari, for the rest of the panelists, we invest our dollars in time, but for a firm like yours, to take on a mandate, it's a commitment of your time resource, which I always consider to be very valuable. So when a management team comes in, is there a vetting process that you go through to determine, I'm going to take this team on board because there's so many hours in a day?
Yeah, no, that's a great point. We always vary where everybody's an engineer or everybody's talking like an engineer. I used to be a chemical engineer, so I used to be in that group. I think what's important is the diversity of skills and relationships and track record among the management team. There's got to be somebody, if it's a technology play, there's got to be somebody who can talk proficiently in commercial level as opposed to technical level about what the value proposition of the company. It also has to be somebody who have the vision and the ability to execute on the commercializations of the product or the services of the company. And then when it comes to thinking about the team, I think it's also important to look at the track record. It's like anything else, right? We would do a bit of a KYC, calling you, Shawn, and ask about a management team, and just hear what the people in the industry are saying about them.
Right. I think we're going to try Mike again. Mike, if you could give us a little synopsis about what Enisphere does and what the types of investments and when you enter these types of companies.
Sure. Hopefully that's better, Shawn. Do you hear me a little bit better?
It is a little bit better.
Okay. Goodness, guys. I'm not in my office. I apologize. I don't have internet issues here, so I'm not sorry for that. Of course, today, the panel. So I'll just kind of cover a quick overview of Enisphere. We are an early stage VC. We come in quite early in companies that might be commercializing and licensing technology from a research university. So just, as an example, across the mountain states and Midwest states, we have strong relationships with what are called R1 research universities, including Texas Tech, for example. So we are looking quite early for technologies, and in most cases we'll invest as early as pre-seed, and and then our main target is a seed and A round, usually investing about $3 million between a couple of rounds. That's our target.
And the when you were doing that, you have a view of further capital needs. I know that I've discussed with some of the panelists that sometimes the capital needs come from capital providers like us, but I think a number of times you've also helped companies with government money that comes in to provide some grant money. Can you talk about some of the sources and what role you play in that?
Yeah, Shawn, for early investors, that's a pretty critical source of funding overall. We're quite aggressive in backing companies, and as part of what's called use of funds, allowing the companies, in fact, encouraging the companies to use outside grant writers for SBIR grants, which is what's most typical. This is funding that's going to come from agencies like Department of Energy, National Institutes of Health, National Science Foundation, and others. I'd say it's pretty typical for companies that we're backing to bring in several $1 million in non-dilutive funding in the early stages with the equity capital that we've invested. Very, very important part of our strategy. And one of the reasons we like technologies that have been licensed from research universities is there tends to be a track record of winning these kind of grants, and frankly, the prowess to know how to go out and secure this kind of funding in a startup. So that's quite important part of our strategy.
I know it's been my experience, and Paul, you might talk about it as well, but Mike, a lot of times when these entrepreneurs or folks that may be really deep in experience, either on the technology or the project side, but they've never really been part of an organization and knowing all the bits that are required in an organization. Mike and Paul, maybe Mike first, and then Paul, do you play a role in helping them sort of set up their organizations and best practices on how to manage a company?
Yeah, Shawn, that's a very important part of early stage investors supporting the company. I mean, for example, we deploy what we just call playbook in about the first 6 months. Really just helping the company post-investment get off and running, get their hiring, for example, very quickly, very quickly addressing hiring needs. We're going to source usually what are called independent or third board members into a company where we know the CEO in particular probably has a gap in knowledge. So that's going to really run the gamut from key hires, board, outside advisors, technical advisors, and up to and including recommending, for example, where to go outsource software development, something as seemingly mundane as that. We're very, very hands-on in that regard, and that's a critical success factor for companies that we're investing in quite early on. And that is a bit unique to early stage VC. I don't think what we do, frankly, is that different than other funds, but that's a critical part of the package that comes with industry fund investment.
Paul?
So as I've said, we sort of enter the movie a little later at the good to great phase, but we do have post-closing services is what we call it. We have a library of approved service providers to do things that they might not have had to do before, help them set up dashboards, reports that help them manage the business as it scales. So we do have a lot of ways to help them, and part of that is to help them, and part of that is to see whether they'll listen, because we've all seen this phenomenon. And the last thing I want to be is cynical investor guy, but there's a lot of entrepreneurs and people that have grown companies in a sole proprietorship environment without a board or without any external accountability that know they need help. They say they want help. They mean it when they say it, but the moment that it takes where they have to let control go of something in order to accept help, they just can't do it. And so part of the post-closing process for us is to make sure that they actually will take the advice they say they want in one area or another.
Great. Paul, I'm going to ask you another question. In the sort of different types of ways you can invest, from debt to straight up heads equity to something that may be more hybrid like a preferred or other areas. I mean, here at EnCap, it seems like the old Henry Ford. out of the 240 companies we've invested, you can have the car in any color as long as it's black. We've got one format, and it's like, here's our structure. But your website seems to make it look like you will look at a number of different ways. How do you decide, which way you're going to use?
It has a lot to do with the people. And I will say that alignment is a big, big deal. You and I both went to law school, and so we can structure a very exotic security that will get its money back, unless you're in some sort of a incredibly early phase. And we're going to leave that to Mike. But you can overstructure it such that you actually don't have alignment with the management team going forward, because you have a different set of liquidation economics than they do. So making sure that there's alignment, not just from the management team, but from us, is really a guiding light in how we structure things. The other thing that ought to be said, given the way you set up the question, is Vista, the very, 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 very successful software shop in Austin, they have, their founder is famous for saying software is like chicken. And when you step in the Vista platform, any independent identity or bespokeness that you claim for yourself is gone. They have a way that they do it, and it really works. So I think that formulaic approach that Vista has brought to the playing field is really interesting, and I need to know more about it, because we really do this for better or worse.
So Ari, when a related question. So someone comes in and says, I've got this great idea. I need to grow my company. They may not know even the quantum that they're going to need right now. How do you counsel them on, the next steps of going after capital, and what structure it look like, and what sort of audience you'll bring those opportunities to?
No, that's a great question, Shawn. One of the things that we do a lot is that we help a lot of oil and gas companies think about various energy transition segments. So we do have a very strong view about the size of the potential of the market in the next 5 years and the 10 years. And oftentimes our view is quite different than the consultants that are writing all of these papers. The reason is because we run an economic model on certain segment of energy transition, for example, and we do have a long-term view of the market size. And that's where we tend to help a lot of our new startup companies client, really understanding what's their market going to look like. Sometimes more conservative than their own internal assumptions. Sometimes we are more aggressive. But then at the end of the day, when we bring a startup client to raise capital to a company like yours, Shawn, we need to stand behind our information memorandum, and typically within that information memorandum, we'll have what is the forecast of the TAM, SAM, and SOM in the next 5 and 10 years. So I think that's the key. I think the other part is the review of the startup companies' businesses and see what the competition is going to look like. Do they have enough barriers of entry, be it patent, be it unique business model, be it relationships? And if they don't, how they need to establish key relationship in order to secure those barriers of entry, so they can have a greater market share of the market forecast.
Thank you for that. So Mike, you've mentioned, I think that you classify yourself more as a venture capital, and that means you're on. How do you do it? How do you assess a technology risk that hasn't been proven yet, whether it's a software platform that hasn't been fully built out, or a new widget that can do something better or more efficiently?
Yeah, Shawn, there's no real easy answer to that, Paul. I think the private equity guys leave the big zeros, to the venture folks, right? Because there's a lot of technology risk in what we do. We understand, frankly, investing in harder technologies, and that is our investment thesis, and that's frankly what differentiates our fund. Not criticizing SaaS funds, but it's much harder to build medical devices and our investors, our limited partners, come from industry, and they're our first line of defense. We were looking at, for example, a really interesting predictive analytics software company for hard industrial manufacturing. And guess what? We have three CEOs of public companies in hard manufacturing. So he said, okay, you clearly have seen something like this already. Give us some insight on what you think is needed in your operation. So you do the homework, you do the work to do the analytics. 100% a little different in venture. We're really trying to decide, is a reasonably large short-term market that the company can get traction in and then go later stage VC private equity. So so I don't think there's exactly a formula, but it's you do the work on the front end, you pick carefully, you vet, bring the experts in, don't trust your own instincts on these deals.
Great, thanks.
Shawn, can I add a little bit on that? May I add a little bit
Absolutely.
about that technology point? So that's a great question, right? Before we take on a client, especially around new technology, we were always wondering, will the technology work? We have worked with independent engineers, for example, and have them write an opinion on the new technologies. We also have observed that a lot of the technology used in the energy sector might sound very exotic and new to us, but in reality, it's been around for centuries sometimes. Like the Sabatier reaction that, or some of the chemical reaction used to create synthetic fuels, they were already heavily employed in other parts of the world. For example, during the apartheid period in South Africa, where they had embargo of fuel and coal import, and they had to resort to synthetic fuel. So I think depends obviously on the startup technology, but a lot of the times that we found is that the technology being presented or used by a new startup tend to be a mild variation of existing reliable industry that's been financed and used for years.
Paul, is there do you guys take new technology risk? I think you said before you're not really on the venture, you're going from good to great. So it's all proven once it comes in your door. Is that right?
You're mute, Paul.
Yeah.
It has to be proven. We might help point it at a different industry. There's a collar that has ultrasound sensors involved that can sense flow and identity of chemicals, for example. You might think of a different market, help point it at that market, learn the language of that market, get a reference customer. So you might shift it across use cases, but we wouldn't prove it up.
Paul, do you need somebody with a balance sheet to provide performance guarantee and warranty of those technologies?
No.
Okay, that's promising.
Well,
the other thing that brings up a point, Shawn, that we should probably say. People make a lot of intellectual property, and do you have your proper protections domestically and abroad? My perspective on that, and it might be controversial, is that's a box that you check. It's not really value that people pay for. It's where you'll get tripped up dealing with a big company because they have to check the box. But all these people that think they have all this valuable IP that somebody's dying to come pay for, I've never seen that. I've never seen people pay for IP. But that could be a topic for the whole panel if people disagree.
Right. Are there risks that you think that you are suited to manage, that I'm not going to use the term arbitrage, but that wow, I can take this type of risk, maybe the growth risk or the onboarding risk or the further risk that you think this is something that we at Genesis Park are well suited to accept or manage? Or do you take positions like that?
I think execution risk and all that involves, there's capital projects, there's time to market, there's, high grading the management team. All those things need to happen before enterprise value does what you want it to do. So execution risk we will take, time risk to some degree we will take. Technology risk, we won't. And then concentration on the customer side is another risk that we take a hard look at. Everybody likes the DoD or Exxon or Walmart or something like that, but you really don't want too much of that.
Right. Well, Mike, we're going to try you again. What is your average time horizon to be in an investment, or do you have a limit on how long you're in your investments?
Yeah, Shawn, hopefully this is a little bit better. Is that
sound? Oh, much.
Oh, okay. Guys, I have no clue what's going on my end. Sorry about that. So Shawn, we don't have a specific time limit, but we are in a venture capital class that's called micro VC. Smaller funds tend to have more expertise on investing earlier and then seeking what we call earlier exits, meaning buyout to private equity, recapitalization, oftentimes to larger funds that are doing later stage investment. So we're looking to hold our investments around 3 to 5 years. And so, for example, 2 exits out of Fund 1 followed exactly that path: 1 buyout, 1 acquisition. And then we do some medical investing as well. And kind of by definition, post FDA approval for a medical device, it'll be ready to exit. That's not the energy sector, but so we have a very specific type of company we're seeking that can fit that profile. So think again 3 to 5 years, kind of in that time frame.
And then within that time, that you'll be completely out, or that Willie brought in the Series B, C, and D, and then get out. Is that how you look at it?
Yeah, we're certainly every deal is a little bit different as it evolves, but the best case scenario for us is a private equity buyout or a straight acquisition. So we're very carefully picking companies we think can follow that pathway. That's the predominant exit scenario for smaller funds, micro VCs.
Right. Paul, on your website, I'm going to reference something that you wrote that I thought was really interesting, and it's a topic I wanted to cover anyway, because it's front and center of a lot of investing. I watched just over the last importance, and that's ESG. The narrative you wrote made it sound like, I don't care what anybody else does. I'm doing it because it's the right thing to do personally, but also it probably parlays into, it turns into a good return on your investment. Can you speak to that, what you wrote and what your philosophy is on these sort of topics?
Wow. I did write that. I'd love to say we outsourced it to a consultant or something, but I actually did write it. And I know you could tell. But the gist of it is, you got to be engaged. Earlier in your career, you look for reasons. Oh, I have to do this investment because it checks all my boxes, or I can't find a reason not to. And then later on, you're like, I do better at things I want to do. And things that you want to do tend to be good things. They have value propositions associated with them that you're proud to go talk about around the dinner table. And so, again, I don't mean to offend anybody, but, cannabis, and there's been some, these, I don't know what they are really. I guess they're testosterone mixing plants or something. I don't know what they are, but they're sort of one-off Viagra salesman or something. And not that there's not good in all of these things, but micro lending at the payday level with, astronomical, what I thought were usurious rates of return, those things walk in the door and you just go, no thanks, no thanks. There's other things to do. So again, I do think maybe that goes back to my attention span, and that I want to pay attention to things that I'm excited about. And it's hard to get excited about things that are predatory in nature.
Yeah. And Ari, not only are you the head of the Chicago office for them, but you also run the DEI practice there. Has Marathon ever run into cases where you didn't take on a client because you said, there's just some reputational risk or bad actor risk or whatever? You said, it might be a great mandate, but no, I'm not going to take it.
We have, actually. Obviously, I'm not going to say names.
Of course.
But on the flip side of that, we were able to, noticed a very distinct benefit on the startup companies that we took on as a client that care about the S and the G part of ESG. A lot of our clients obviously care about the E part because they're along the renewable energy or clean energy or energy transition sector. But the ones that are caring about the S and G part of it, we found that we went out to the market, to the investor pool. We have very different reception, which is way more positive. I want to talk about something that's publicly announced already, PostClosing. This is a rooftop solar, residential solar company that really focused on low-income housing and low-income communities and bring back jobs to low-income communities. We raised Series D, and they get a really good reception from an investor because it really checks in the E, S, and G, not just the E part. We also just recently bring to market and successfully completed a capital raise for a woman-owned startup, and again, really get good receptivity, resulting in maybe still market prices, but much greater attention from the investment communities. So we do care about the E and the S and the G when we look at clients.
And Mike, in the 10 years since you've been at Innisphere, have you seen this trend, and how does it factor into your decisions?
Yeah, so our fund thesis kind of all along has been, you might even call it impact, although we're not impact investors. But for example, we invested in software that helps first responders organize major crime, major scenes, Boston Marathon bombing, church shootings. So, Paul, to your point, you feel good about what that company's doing. It's also a good business, as it turns out. And so, when we look across really everything we're doing, Paul, I totally get what you're saying. Every company we've invested in, and we don't consider ourselves impact investors. In fact, we're financial investors. But to a company, every single startup we've backed on their own has a strong mission. We just are investing in a company in closing that's not in the energy space. Again, sorry for the analogy here, but that's doing some really critical work in rapid diagnostics. And so coming out of COVID and the recognition that societally we're probably not going back to primary care for routine diagnostic testing, this is going to transform. These technologies will transform this industry. And there'll be winners, and we hope we pick a few. But it fundamentally is going to be part of a transition in healthcare. Same thing on an investment, Shawn, we did in a company around large electric vehicle charging. We know as part of energy transition, fleet operators are moving this direction, and we want to be in early in that. But if you look at the industries that are being served there, school districts, municipalities, private fleets, you feel good about that work at the end of the day. And so I think across our portfolio, we very much select for we not only believe in the technology and the team, but is it doing something more broadly from a societal perspective that's of value?
Okay, I'm going to field what I think is a question maybe from the audience, and I'll just set it up by saying when EnCap courted our group, we stood up at another fund to do sort of sustainable investing and renewables investing, also financial objective, not a social objective per se. But the question goes like this: what did the investment community learn from the 2005 to 2008 wave of renewable investments on the VC sector that actually didn't end up so well? And I remember when EnCap, what we call the mothership, the oil and gas people were asking, said, everybody always loses money in renewables, isn't that right? And we said, no, that's certainly not right. But there were some high profile examples that made the press where it sounded like with the whole brush that renewables per se. But I think this is more like, so what was learned in that period of time? Paul, what would you say was the takeaway?
You're on mute, Paul.
You'd think I'd learn. So I think people are generally talking about John Doerr, and they're talking about Kleiner Perkins when they make that remark. And I haven't done this math, but they claim that if you total up all those investments now, that they actually look pretty good in hindsight. But certainly there was a lot of wreckage along the road. And I think part of the problem is that they wrote $200 million checks because they could, because they were Kleiner Perkins. Well, most of these things, that's the worst thing you could do to them, would be to hand them $200 million. I know that these things tend to be capital intensive, but is the market ready to adopt them? Again, we did this at NRG, so I'm pleading guilty to sins that I have committed, where you invest heavily in a capital intensive business that the market's not ready for.
Yeah.
ChargePoint today has what, a $6 billion valuation. Well, we built EVgo for a couple of $100 million and basically gave it away.
Well, I'm not going to talk about my investing, Salvi. I would have shorted Amazon when it came out. So, hey, Ari, what do you think about financing emerging technologies like carbon capture and some of the challenges around CCSU and these emerging technologies right now?
So we're very bullish on CCUS, carbon capture. I think Paul mentioned it earlier. The energy transition will just not happen without carbon capture and utilizing it elsewhere on for example, carbon concrete or sequestered them. So what's quite interesting is that there's now a lot of CCUS coming to realization, getting built, getting operating. And also there's a unique form of financing, project financing, which benefits from the 45Q carbon tax credit when you have a carbon capture utilization and sequestration project. So we actually going to announce, I think, the first ever carbon capture project financing capital raise in a 100 million size. And I think what's really interesting is that the levelized cost of carbon capture per dollar per CO2 equivalent has become profitable when compared to the revenue potential from monetizing the tax credit. I know some people might say this might not be true economic profit, but how else are you going to capture the externalities of carbon emission in a country like us where there's no carbon tax? This is going to be even more prevalent and pronounced in countries and territories and regions where there are carbon tax, like in Canada or in EU. The thing that's quite important is that this CCUS, carbon capture, utilization, and sequestration, will provide a lot of opportunity for incumbent oil and gas companies to be part of the energy transition movement, because they are the people who really know geology. They have the cavern. They also have the industrial processes that can be decarbonized and reduce the carbon footprint using CCUS. So we're very bullish. We're very excited. We have a few big announcements coming up in the next month or so along raising capital on large CCUS projects.
Thank you. Mike, you mentioned EV, and we've now just talked about carbon capture. Is there an area that you're on the prowl for that you haven't transacted? You think that's really interesting. I want to go find something or dig in deeper to see if there is an opportunity in this regard.
Yeah, Shawn, I think one area that we're interested in looking at, and there's definitely companies emerging in this area, is really software that optimizes solar battery and charging, as a system. And there's definitely some aspect of AI machine learning in all that. I think it wouldn't be a pure play AI company per se, but what we've gained some insight into is the tremendous amount of data that, frankly, is coming off of all these assets, and we're not seeing yet great software solutions for that. We've seen a couple of folks trying to get into that area, so that would definitely be an area we're interested in looking at.
Paul, what has you interested in, or is your radar out on these days for hot?
I think community solar as a business model, I've seen pieces of it, and it obviously very geographic specific, probably not in Texas, but I think we're past the tipping point in terms of popular opinion. And if you could figure out how to use the right technology and the right back office, obviously the community installation itself is fairly easy to build and maintain and sell power back to the grid. But if you had the right sort of consumer software in the background that made everybody feel good about their tax credits and their 4 cents they were getting on net metering and how many cars they'd taken off the road equivalent, I do think that community solar has, there's a life out there for it, and I just haven't seen it yet.
Yeah. There for us, there was an activity that we wanted to go after, but we didn't have the team that we wanted. So we actually assembled the team to do what we said was an opportunity that we wanted somebody to prosecute. We assembled that. Ari, from the investment banking side, you and Kelly and some of my partners had an exchange that kind of was deja vu for me, in that it seemed like you were trying to do something that was outside of the norm for an iBank, and that is to kind of bring along a mission on EV charging and fleet charging and all this. I thought that was really interesting. Is that something you've done before? Because it looked like you were trying to help assemble a team, and I've never seen it.
Yeah, no, it's all
before.
Yeah, it all came about because when we're advising big industrial companies and C&I commercial industrial companies that are big emitter, we learned that it's easy for them to decarbonize scope 2. Just they sign corporate PPA or monetize RECs and make tax equity investments. We've done all of that for them. But then when it comes to decarbonizing transportation, it's, as we all know, it's very hard at the moment. And when they try to do that, because they have big mandates from their global corporation headquarters, they are suddenly realizing that there is no real comprehensive turnkey provider for fleet electrification. So there are charging businesses, there are the EV provider, but then there's somebody who's also going to be providing sort of the microgrid, but there's nobody yet that just integrate everything. Talking to the utility to expand the interconnection of electricity into those vehicle depot, somebody who can monetize the tax credit, somebody who can provide sort of like an expert system to create a charging modules and program for the drivers. And a lot of these corporations, big emitters, they just don't have that capability. I mean, they're coming from having drivers running diesel trucks or delivery vans, and then suddenly they need to think about bringing in storage system, signing up charging agreement, thinking about what is the charging model should look like based on the transportation model. And I think there's a great opportunity to be sort of a turnkey provider for fleet, electrification of fleet, especially around big companies that are running a lot of transportation logistics.
Oh, thank you. Hey, Paul, for your exits, there's a bunch of different ways to get out and realize value on an investment. You've got public company experience. You've done private sales and exits, and you've even touched the SPAC universe. How do you look at your exits, and what engagement do you have with your investees, the companies you're investing into, about, hey, this is what I want to get you ready for within this time horizon. We're going to go for a public IPO or a de-SPAC, or I want you to get to this size, and then we're going to call Ari and he's going to run a process. How do you look at the exit piece of the equation?
That's a good question, because it's changing. Obviously, our SBIC fund has more of a credit texture to it, and we do want the equity strip, we want the alignment, we want the warrant. So we're not just staring at our covenants, making sure everything's good for us. But those are exits where the company doesn't have to monetize. But in the control private equity business, I think it's really important to have, we're doing this right now, by the way, have an eyeball to eyeball conversation with the entrepreneur and say, the reason we're going to set up your financial reporting so it looks like a data room is because it is a data room. So 5 years from now, there will be a monetization event. And if there's not, great, but you just have to get your mind around the fact that the nature of fund money and the nature of private equity is that you have to capture enterprise value. That means a change of control transaction. I'm sorry, but please, let's get that real clear right now, because to mamby-pamby around it, to me, just begs for litigation later.
We're still friends. The relationship's not over. We still be friends. You can call. So Ari,
can I add? Yeah. This is near dear to me, because I'm trying to find more options for you, equity and VC investors, to monetize your investment. So de-SPACing, we've done that. Selling it to strategic, selling it to later stage private equity funds from VC. But one thing that I think was quite exciting is the notion that investors that are typically more risk averse are going up the risk spectrum to invest on riskier investment opportunities. Given the notion of the alternative would be not having exposure or not having anything invested in around clean energy sector, and while they still have their carbon liabilities exposed. Great example are family offices. So a lot of family offices, especially from Europe, become equity investor in later stage startup because they want to leave the world a better place, right? They have a different mandate. They're still return-seeking investors, but they are increasingly looking into making equity investment into startups, later stage startups typically. Give an example that's public is the family that owns Lego, the toys. We've helped them to invest into startup companies, and they're still return seeking entity, but their mindset and their motivation is very different. I like to quote the family, because they're saying our business comes from children. Well, the children is the future. We need to make sure that these children will have a good future by investing into energy transition segments.
Ari, sticking with you, can you talk about the role of oil and gas majors in backing startups? You have to go kind of across the board to find, what's the right capital for the right opportunity. Do you see oil and gas playing a role in backing startups?
I think they play a very important role. A lot of the business model, the value chain of a lot of startups would be failed without involvement from oil and gas sector. If a startup is working on the next renewable fuels, who's going to be delivering the fuel? Well, it's going to be the midstream and the downstream companies, right? A lot of startup are focusing on renewable electricity, for example, in windy sunny states. Well, it just so happened that windy sunny states are also sparsely populated, except for the big pipelines going through middle of Nebraska that could be the only consumers of electricity that could be powered using renewable. And then I think lastly, or second to last, is the notion that carbon and carbon capture, carbon emission is big part of the startup community focus, especially along energy transition and ESG. And the people who can actually handle large and scale up any kind of startup businesses around CCUS are, like I said before, the oil and gas companies.
So we just got a few more minutes, 1 minute each to you guys. I presume there might be some budding entrepreneurs who might watch this panel. What would be your 1 minute advice to them? Paul, I'll start it with you. Let's go in this order. What would you say to them?
Gosh, it's hard to do this without sounding trite, but be persistent but flexible. Have a vision, but don't block out what the market is telling you, because the chance that away. I mean, what great company is that not true of? I tell people to go read Shoe Dog, not because Phil Ditz did such a great job building Nike. He did everything wrong. So it's encouraging for the rest of us. And so, be firm, be persistent, but be flexible and build a patient balance sheet. Don't pile a bunch of debt up. You just put a bullet in your head.
Ari, you next. Some budding entrepreneur comes into Marathon. What's your advice?
My advice would be to look at the alternative solution that might be carbon heavy, and then think about the cost of doing nothing for those users of the alternative carbon heavy solution. We might never have carbon tax in the United States, but the future carbon liability is going to come in the form of credit rating agencies saying, Company A, you're committing carbon today. If you're not doing anything in order to incorporate a mitigation for your carbon liability of the future, I'm going to downgrade your credit rating today. So for those entrepreneurs, especially the ones that are competing with carbon heavy alternative, those are some of the things that I think would be fun to just run a model around and see what's the impact of their solution versus the carbon heavy solution.
And so, Mike, you're the VC guy. My niece has a great idea. I send her to you. What's your advice?
Mine's pretty straightforward. If you're a strong technical founder, find a business person. If you're a business person trying to start a company, find a great technical founder. Because normally we get 3 PhDs and a dog walking through the door, and they have no idea that, they're shooting at a $50 million market. They spent a whole bunch of time working on a technology. So, it's kind of tongue in cheek, but true.
That's great. What a great note to end on. Brian, are you taking over? I don't know. Maybe am I wrapping this up, or Brian? I see that maybe you're going to be closing us out.
Hey, Shawn. Yes, I'm gonna close this out. I loved all your final comments there about all that stuff. I would say one thing is budding entrepreneurs should do customer discovery exercise first before deciding if they are going to start a company, to make sure there's a market for what they're doing. That's my only. If I was on the panel, my fourth point maybe to make is a little customer discovery to find out if there's actually a market for their widget or whatnot. But great panel, Shawn, and thanks so much for doing all this.
Ari, Paul, and Mike, thank you very much. I appreciate it.
Thank you. Bye-bye.
Thank you.
Great. So that's the end of day 3 of Energy Week. Again, I'm Brian Korgel, director of the Energy Institute. It's been a really great set of panels. I mean, very informative for me, for sure. So I've really enjoyed it. I want to announce a few more things going on. So there are still a couple more activities tomorrow as part of UT Energy Week. So there's a webinar on the future of oil and gas and the age of decarbonization at 1 p.m. via Zoom. So I think that'll be an interesting panel. And then we've got some events happening tomorrow. Big deal, at least in the Cockrell School of Engineering. We have a new energy building that is having its ribbon cutting ceremony tomorrow, the Gary L. Thomas building. So we're very excited about that. If you happen to be on campus and in Austin, please feel free to join us. The ceremony starts at 2:30 p.m. GLT building is around all the engineering buildings, and it should be pretty fun. After the ribbon cutting, we're going to have a panel. I guess before I jump to that, I'll just say our next UT Energy Symposium next week. I'm looking forward to Christine Williams, Gaslighted, How the Oil and Gas Industry Shortchanges Women Scientists. And then on March 31st is a big McCombs Energy Initiative Conference meeting global energy demand. So this, after the ribbon cutting, will be a live in-person panel. So again, if you happen to be around, it'll be in the new Gary L. Thomas Energy Engineering building on the 5th floor in the Hildebrand Lecture Hall. I'll be moderating that. Go to the next slide. On our energy future. So we've got a couple of our faculty, Joan Brennicke from the McKetty Department of Chemical Engineering, Sheila Olmstead from the LBJ School, along with Helga Halderson and Jean Shepard. And that should be really fun. I'm looking forward to it. Next slide. So this event from the McCombs Energy Initiative Conference on March 31st is a reception, and the conference is April 1st. I think that's going to be a really great event sponsored by EnCap Investments. Looking forward to that as well. So again, happy to be closing out day 3 of Energy Week. Wanted to give a shout out and thanks to the Energy Institute folks who really did all the work to put this on. So Dave Tuttle, Eric Funkhauser, Carrie King, Krista Hopkins, and John Peck really did an exceptional job to organize everything, get everyone's calendars aligned, and that sort of thing. And it's no small feat to put on Energy Week, and it's one of the highlights of our activities, education and outreach activities in the Energy Institute at the University of Texas at Austin. So with that, I'll sign off. Thanks for joining, and hope to see you all in person at some point. Hopefully it'll be in person next year. Thanks a lot.